Yeah, well, I think gold was a little bit of a crowded play. I think the whole kind of world economy, when they get nervous, they move to gold. So that is, that's where I think a lot of emotional money has been moving, and there's been a lot of FOMO. A lot of people I talk to who aren't in gold have been painfully watching it go higher, and they all want to get in. And so I think we're just seeing some profit taking. We've had the news with the tariffs, kind of another delay, a pause of tariffs. And so that is strengthening the US dollar. The dollar is going up, so gold's falling in kind of the inverse relationship. So we're just seeing, I think, some profit taking, people moving out of that play, thinking there might be some good news that come out of the China tariff deal down the road. So I think it's just that everybody who piled in is now nervous, and now they're kind of quickly pulling back the reins. And whatever moves up the most is usually the one that pulls back the most. And gold has definitely been outperforming. Silver has been struggling, and so that's I think the reason for silver really just holding its ground today, while gold kind of takes a bit of a beating. Yeah, I mean, if we take a look at the gold market, if we pull up gold here, gold has had a very nice move. It's recently pulled back. We've been slowly kind of actively trading this. We did get into a gold trade. We closed some out a few days ago, and gold has kind of made this, is having a pause. This is a significant level. Gold could still consolidate here and move up based on the charts. Gold has the potential to rally to $3,750, which is a substantial move to the upside from where we are right now. That's somewhere up to this range. So gold is in a bull market phase. You don't want to bet against it. What's really interesting, Elijah, is when we look at the monthly chart of gold and kind of zoom out on the big picture. I think you and I may have touched on this before, but I use Fibonacci extensions, which is the golden sequence, to identify where price targets for gold are to the upside. And we've hit multiple 100% measured moves in gold over time. And these levels I'm drawing are kind of where gold has hit rough Fibonacci targets. And what's really interesting here is each time we've hit a target and then gold has blown past it and become that kind of crowded play where we really just see it kind of drift higher and move up. Each time it's done this, including the big one we've seen right now, has been about 22 to 24% move to the upside from the 100% targets we were looking for. And so I find it very interesting that each time we've done this, we've gone into a multi-year pause or a financial reset. And it's not that everybody in the world is like piling into gold. It's actually, a very tiny percentage of most portfolios, of most advisors. But the thing is, people who do hold gold right now, they know we're in a bull market phase and they don't want to sell it. And so it doesn't take much buying for gold to just quickly drift higher, because anybody who has it says, well, I'll sell it to you, but give me, pay me through the nose for it. And so that's why we see gold in these phases here drift higher very easily. So I am, based on that, short-term wise, as I told you, I think there's potential for gold to maybe push a little bit higher. But overall, based on historical price action and percentage moves, it is indicating that gold may have actually kind of had the top here, and we're going to see a bigger pause and correction with the overall economy and the stock market, and pull back and give us a pause. The last time we've had a pause like this, where we went into an economic kind of crisis and a financial reset, was in 2008, and gold pulled back about 34%. So in a perfect world, that's what we'd see here. We see gold pull back with the stock market over the next 4, 5, 6 months, and then gold would probably be off to the races after that. So short term, you don't want to bet against it. It's still bullish, but when you look at the big picture, all the signs are there, including these monthly charts, these candle wicks. If we just zoom in, when price runs up and then gets slammed down and then runs up again and gets slammed down, that's usually a sign that the market is a little bit exhausted. And the big question is this an exhaustion move and it's going to break down and unwind like I think it might? Or is it just a pause, a consolidation before it pushes up for that next leg higher? And that's the nice thing about technical analysis, is we follow price. We don't pick a top or a bottom. We just wait for a trend to start or continue, and then we jump on and trade that. So I'm still bullish on gold, but you got to be aware it is in definitely a unique situation of, there's limited upside and potentially more downside or wasted time if you were to move into it right now. It could take a little while to mature before it has the next big leg to the upside. Yeah, so gold and silvers generally should hold up a little bit. The gold may still want to push higher as the stock market here struggles. I think in the next 1 to 3 months, I think we could see the stock market really stall out and start moving sharply lower. And once it starts to pick up speed to the downside, that's when that fear is going to start to ramp up, and then precious metals will pull back. So we are still in a sweet spot where gold and silver can hold their value and move up, even if the stock market starts to sell off here over the next month or so. But eventually, when the fear hits a certain level, everything kind of gets sucked down with it. So I think we're within a month or 3 window where you got to be aware that both stocks and precious metals could be falling precipitously together. Yeah, I mean, I think it kickstarted things. Things way before this, and you and I have talked about this for months, well before all this started, is everything that I follow, from the technicals of different money flowing between different assets and different commodities, all the way to like real estate and economic data, has been showing to me that it's been slowing. The tide has changed. It's gone from, strong economy to a kind of a sideways weak economy, and I believe everything now is sloping down in terms of all that kind of data. So things were slowly breaking down and weakening, and then I think the whole tariff thing was just enough to kind of snap that trend and kickstart that first drop. And so now the markets are trying to claw their way back up, and the news that we have going on right now with the China and the US, this huge pop in equities, is sending price up towards 150, 200-day moving average. It's broken a previous high from a month or two ago. Everyone is getting really bullish, and this is what the market is best at doing, is getting everybody really bullish again and get them sucked into the market just before it rolls over and goes off a cliff. And we're seeing big distribution selling. Institutions are unloading massive volume in overnight trading. Stock market was trading higher overnight. We keep seeing big bouts of high volume selling on the futures markets, and during regular trading hours today, the market's getting hammered, and then with big selling, and then they let the market drift higher. Retail buyers think we're starting a new bull market. And so the institutions are unloading into this buying pressure. And this news is exactly like what happens to the average investor. It gets them all excited. They get long, and then the market reverses and crashes a few days later. And they're like, how did I just buy this high again? And the market's falling. So that's what people need to be aware of. And we're seeing it on even our custom indicators. It tells us that there's FOMO in the market. If people feel like they're missing out and they don't care what price they pay for stocks, we have that spiking today. And every time we see that spike, the market takes a pause or pull back. And it's a warning sign to be very cautious. Yeah, I mean, I think Buffett's probably got a pretty good team of what's going on. We've been raising cash for long-term investing account. We're all cash. I believe inflation is here to stay for a while. I think it could go up. I think interest rates are going to hang in tight where they are, or push actually higher and kill the price of bonds. So you don't want to hold bonds. I think there's a lot of downside risk there. I think one of the best plays and one of the most boring plays is simply holding a cash position, earning 4%. If the markets have no real clear direction and there's crazy volatility, as a long-term investor, just sitting on the sidelines, earning interest, even though it may be lower than inflation, it's way better than losing your shirt and giving back 20, 30, 40, 50% of your wealth, and keep that gunpowder dry. So once we do have a pullback and correction, you can load up on gold, on silver, on the companies that you like, and then take advantage of it. So right now it's more so capital preservation, just like Buffett. Cash is a position, even though some people think it's not. And if you don't think cash is a position, eventually you're going to take a hit, because you're going to be invested in stuff because you don't like cash. And pretty much everything goes down in a financial reset. And then you'll regret, why didn't I just step aside and, keep earning interest instead of losing everything? Yeah, I don't use it for positions or anything like that. I always follow the long-term charts, like the monthly charts of gold and silver, to identify what to get into. So I would think naturally silver will fall a lot more percentage-wise, and I think we'll see this gold ratio stay high or go higher, which is, in the long term, I think it's a good sign to own more silver. But overall, I don't use it towards any trading. I more or less, I wait for the asset I like to carve out a bottom, start to trade up and trend up. And then I'll be like, okay, how much do I want to put into silver? How much do I want to put into gold? And then I just kind of go from there.